This is chapter 12, the final chapter of our course. So in this chapter, we're going to perform an industry and company analysis. We'll perform a horizontal analysis, perform a vertical analysis. We'll also use ratios to make business decisions, and we'll evaluate the quality of earnings. This chapter is essentially just there's a whole semester class on financial statement analysis. So what this chapter does is really just take all the ratios and various analysis tools that we've learned throughout the course and combine them into one place. So I would say 75% of this material will be review, and there's only about 25% of new material, mostly around a horizontal analysis and a vertical analysis, both of which are pretty straightforward, I would hope. So let's look at performing an industry and company analysis. So why would you want to do this? Well, you need to really understand a company's business and industry in order to make a decision based on a specific company, right? You really the important concept is, how is your company performing relative to other companies? So where would we get some of this information? Well, the annual report that's filed with the SEC, also known as the 10K, right? We do that. We did a project where you had to look through that. And so there's some sections within the report. Not only do you have this financial statements that we've looked at throughout this semester, but you'll also have sections like the management's discussion and analysis section. So you can read about what the management thinks about the company, how it's performing, how the industry is performing, and all that good stuff. So again, the 10K, this annual report filed with the SEC, right? That's also known as the 10K. Very, very important document, and in business, you will use it quite a lot. So here's some, first kind of step is, you'll see, in this case, we're looking at Under Armour. And the important concept here is that we're going and looking at Under Armour from 1 year to the next, right? Again, it's relative. So what is their performance in 2016? Well, if I only look at 2016, it doesn't tell me much. But if I look at the previous 2 years, I can see, for example, that, look, revenues have grown consistently, right? We were at around 3 million in 2014, almost 4 million in 2015, almost 5 million in 2016. So just by looking at that trend, I can tell that Under Armour sales are increasing. Obviously, I need to do a lot more analysis, but right away, just by being able to look at year to year, you get a sense of what's going on with the company. You can also show this graphically. So in the real world, obviously you'll have a lot of data in Excel, but Excel has a lot of great tools where you can quickly take the data and have Excel create graphs for you. And as humans, sometimes a visual representation works much better for us. So here's an example of a visual representation, because it clearly shows the growth, right? So we can clearly see how the company is growing. So we kind of already did this, but now we'll put a specific name to it. We'll perform a horizontal analysis. So horizontal analysis is just the study of percentages from year to year. To compute this percentage from 1 year to the next, there's 2 steps that you must do. You'll first calculate or compute the dollar amount of the change, and then you'll divide that dollar amount by the base period amount. So let's just do an example. It's the easiest way to learn this. So here's Under Armour's revenues from 2015 to 2016. In 2015, they were 3,963,313. In 2016, they were 4,825,335. What is that change? Well, that change is an increase of 862,022. What is that as a percentage? It's 21.8%. So how did we calculate this 21.8%? Well, we took our increase, 862,022, and then divided that by the base year. Multiply that times 100, and that gave us the percentage change, 21.8%. So again, calculate the difference from 1 year to the next. In this case, this was an increase. It could have been a decrease. And then take the base year. In this case, the base year is 2015, right? So this is 2015. And that gives me the calculation of growth from 2015 to 2016. That is horizontal analysis. So if you can see, I have Under Armour's 3 years here. And in between, what I'm doing is calculating the change. So this 3 million to 4 million change was 28.5%. Then the next year, from 2015 to 2016, the change was 21.8%. And so right away, you can see how this horizontal analysis can be helpful, because now I can very quickly and easily see that, yes, revenues are growing each year, but for those of you who are on calculus, I can also look at the second derivative. What is the rate of growth of the rate of growth, right? And you can see that the rate of growth is actually decreasing, right? So my revenues are increasing, but they increased by 28.5%, and then they increased by 21.8%. And generally that's true. The more mature that a company becomes, and the more, let's say, the larger it is, right? The more difficult it is to have really high growth percentages. So that's something to think about. When it's an early company, it's much easier to go from 1 million to 2 million in sales than to go from 1 billion to 2 billion in sales. And here you can also do this in the balance sheet, right? So this is the balance sheet going from 2015 to 2016, and you can see I can calculate the increase or decrease of each item and then calculate the percentage. So this was 120,618. That's the change from 2015 to 2016 of cash and cash equivalents, divided by the base year, which is 2015, 129,852. And so that gives me 92.9%. So cash went from 129,852 to 250,470, which is an increase of 92.9% from 2015 to 2016. And you can do this for each different line item. And then down here for liabilities and stockholders' equity, same exact logic, right? So I can calculate the change and the percentage. Another form of horizontal analysis is a trend percentage, okay? Gives us a good idea of the direction that a business is taking. In this case, I select a base year and make that base year equal to 100%. And then I compare all other years as a percentage of the base year amount, right? So here's the trend percentage is the dollar amount of any year. So it's not the change, it's the actual dollar amount divided by the dollar amount in the base year times 100. So let's look at an example of this. Here you can see 2014, and we're going to treat that as the base year, 2015 and 2016. And you can see the trend of growth, right? So I make this year equal to 100%, and then I compare this year and this year relative to this 100%. So if I look at it here, you can see, let's go down to this lower box, you can see that the base year was 100%, 2015 was 115.4% of the base year, 2016 was 117.9% of the base year, right? So I want to just be clear before I move on. Let me make sure everyone understands the calculation here, how these percentages came about. So this 100% is just 353,955 divided by 353,955, right? So that's going to give us 100%. 2015 is just 408,547. Whoops, that's a 7. Divided by 353,955. That gives me this. And then 2016 is 417,471 divided by 353,955. So as you can see, we're always using the base year 2014 to make this calculation. So each year in a trend percentage is relative to whatever base year you picked. Let's look at a vertical analysis now. So this is going to be slightly different. Here I'm going to look at the relationships of each of the financial statement items for your company. So I'm not going from year to year, although I could, but that would be horizontal analysis combined with vertical analysis. Here, for now, I'm just going to convert all my financial statement items into percentages of whatever the base amount is. On the income statement, the base amount is generally the net revenues. Okay. On the balance sheet, it's usually total assets, and then you also are going to use total liabilities and stockholders' equity. So let me show you an example, because I think that's the easiest way to learn this. So here you can see what I've done is, and this is looking at the income statement. So I have all my income statement line items. I'm going to make net revenues the 100%, and all the other line items in the income statement I am making as a percentage of net revenues. So the way this 49% got calculated is I took this number, 1512206, and divided by my base number, and my base number again is net revenues when I do the income statement of 3084370. That gave me 49%. And I do that everywhere else for each year. And I can do the same thing for the balance sheet, except on the balance sheet, again, on the top portion of the balance sheet, your total assets, this is going to be the base, and everything else is a percentage of that base. Same exact math though, right? So this 6.9% is simply 250,470 divided by the base amount, 3,644,331. Okay, and that gives me 6.9%. When I go to the bottom section of the balance sheet for the liabilities and stockholders' equity, my base amount is here. So this is my base. And everything is a percentage of that base. So that's a vertical analysis. It's basically converting all these line items into percentages. So with that, I can create common size financial statements where I don't even really look at these dollar amounts. I just create financial statements using only the percentages, right? So I'm reporting only those percentages, no dollar amounts. Why would I want to do this? Well, it makes it much easier to compare different companies using a common denominator. In other words, if I'm going to look, let me see if I can get here first, and I'll go back to that slide. So if I compare Under Armour and Nike, Nike is a much larger company than Under Armour is, right? So if I look at their dollar amounts, all the dollar amounts for Nike are going to be larger. But how is that better or worse? It's hard to say. But if I create common size statements and I only look at the percentages, look how quickly I can make some conclusions, draw some conclusions. For example, gross profit. Gross profit at Under Armour, 46.4%. At Nike, 46.2%. So their gross profit is almost identical, but Under Armour has a slight advantage. Their gross profit is slightly higher than Nike's. Right? So right away, without looking at the actual numbers, I can draw some conclusions pretty quickly. And this is called essentially benchmarking, or a way of benchmarking. So benchmarking just means that I'm comparing a company to some standard set by others, right? So very often a benchmark might be, for example, retailers in the let's say that retailers in the sports apparel industry should have a gross profit on average of 40%, right? So then I can look and see, so if that's the benchmark, then I can say, wow, look, both Under Armour and Nike are doing really well. They're doing better than the benchmark. And if I go out and start a clothing company in sports clothing and my gross profit is 30%, I can say, that's pretty low relative to the benchmark. Why is it so low for my company? Is there anything that I can improve? So that's what benchmarking is. So, and this is why we want to convert the financials to common size, which is just this, right? Percentages. Now let's look at some ratios. All of these should effectively be a repeat or a reminder of what we've done throughout the semester. So we can classify ratios into a couple different things, right? And there's many ratios. We cover the most popular ones in business, but certainly we don't cover all of them. But we kind of break it up into a couple different categories. So one is measuring the ability to pay current liabilities. We'll look at some ratios that cover that. Measuring turnover and the cash conversion cycle. So we'll look at that, talk about that a little bit. Measuring leverage. What's the ability to pay debts? Measuring profitability. How profitable is the company? And analyzing a stock as an investment. We can then take ratios that we calculate for our company and compare them to previous years or to the industry, right? And see where we stand. Are we better or worse than the industry? Are we moving in a better or worse direction from year to year within our own company? So let's start with ability to pay current liabilities. What are some ratios we've talked about that give us an idea of our ability to pay the current liabilities? Well, there's the working capital calculation. We can convert that into a ratio by instead of subtracting, dividing, and then we can make it even more conservative by getting rid of anything in our current ratio as current assets that we can't turn into cash quickly. So let's do a reminder of these three ratios. So working capital is simply our current assets minus our current liabilities. This gives us a dollar amount, which, as we've said, sometimes can be hard to interpret. A large company like Apple might have a very big dollar amount, but is that good or bad? We don't necessarily know. So it's much better to take this ratio and take current assets and divide them by current liabilities, right? So we get current ratio. This simply converts it to a percentage, much easier to compare from company to company, right? So in general, the higher this ratio, the stronger the financial position, right? We want current assets to exceed current liabilities. And finally, we have the quick acid test ratio. This is basically the current ratio here. The only thing is we make some adjustments to current assets up here. We take out things that aren't easily converted to cash, like inventory, right? So inventory is not going to show up here. We're just going to look at the things that are easiest to convert to cash, which would be cash and cash equivalents, short-term investments, and any net current receivables, right? And we'll divide that by current liabilities, and there we go. Finally, not finally, but the next one, we did a bunch of turnover calculations, right? Remember the turnover ratio is always a little hard to interpret. It's like, how many times have I, purchased my average inventory when I compare it to cost of goods sold or something? Again, it's not very intuitive. So very often we take it 365, because that's the number of days in a year, divide that by the ratio that we've calculated, and that gives us in terms of days, and that makes it much easier to understand. But some of the ones we've talked about: inventory turnover, accounts receivable turnover, which then turns into days sales outstanding, and accounts payable turnover. And when we look at inventory, accounts receivable, and accounts payable, those three will make up the cash conversion cycle. So let's look at inventory turnover. As a reminder, we take our cost of goods sold for a period, divide it by the average inventory for a period. So just remember, when you're doing the average, you're just doing beginning plus ending divided by 2. So for accounts receivable turnover, we're going to take the net credit sales divided by average net accounts receivable, right? So again, beginning plus ending divided by 2. And we can convert this as we can convert the others, the inventory one as well, and the payables one that we'll calculate in a second. We can convert this into days, right? So in this case, we're taking this ratio, the accounts receivable turnover that we calculated, taking 365, dividing it by that number that we just calculated, and this will give us days sales outstanding. This is much easier intuitively to understand, because then we can think of this as, how many days does it take to collect an average account receivable? And so with accounts payable turnover, we calculate that by taking cost of goods sold, dividing by average accounts payable, right? Beginning plus ending divided by 2. And so that gives us the accounts payable turnover. And again, we can take 365 divided by this number, and that gives us the how many days our payables are outstanding. So if we convert all of these to days, we have days that inventory is outstanding, days that sales are outstanding, days that payables are outstanding, and that gives us the cash conversion cycle. So if you think about the cash conversion cycle intuitively, think of it like this. If I'm Best Buy, how long does it take me to make a purchase of inventory, put that inventory on my shelf, and then collect money from my customer for that inventory, right? That's cash conversion. From the moment I spend cash until the moment I collect cash is my cash conversion cycle. So that is going to be an equation based on days inventory outstanding. So how long does my inventory sit on the shelf? Add to that the days sales outstanding. How long does it take before my accounts receivable get paid? And subtract your days payable outstanding. Am I able to kick the can down the road to pay my accounts payable? If so, look, I could even it's possible to have a negative cash conversion cycle. Think about something like Apple, right? So how long does Apple inventory sit on the shelf? Well, probably close to 0, right? Why? Because half the time when you order something from Apple, it hasn't even been created. When you order it, only then is it going to get created in the factory. Days sales outstanding. How long before you owe your money to Apple? Well, generally, Apple wants your money up front, right? You're going to get nothing. You're not going to even get an account receivable with Apple. So that might be 0. How long do you think Apple can take to pay its suppliers for the aluminum, for the glass, for everything else? Boy, probably as long as they want, 60 days, right? Do you want to do business with Apple? Well, you're going to do what they tell you. So in this case, you can see Apple will probably have a negative cash conversion cycle, which is great for a company, right? If you have a negative cash conversion cycle, you're basically running your company not only without using any cash, but since Apple collected this cash and doesn't have to pay the suppliers for, let's say, 60 days, for 60 days, they can earn interest on this cash that they collected from the customer before they have to pay their suppliers, right? Great business model. And hence, if you look at Apple stock, it's done really well over the last 10, 15 years. Let's talk a little bit about leverage now. So this is our overall ability to pay debts. We would look at the debt ratio and the times interest earned ratio. So the debt ratio just takes our total liabilities and divides it by total assets. It gives us an idea of how levered or how in debt our company is. So at the extreme, we would have a ratio of 1, right? If we have 100 of liabilities and 100 of assets, that means we have 0 stockholders' equity, right? So all of our assets are owned by outside creditors through liabilities. Then we can calculate the times interest earned ratio. This is going to take your income from operations and divide it by your interest expense for a period, right? So it measures the number of times that the operating income covers your interest expense. Obviously, a higher ratio is going to indicate that it's easy to pay the interest that comes due. A low ratio represents difficulty in paying interest. So in the extreme, if your income from operations is 50 and your interest expense is 50, you spend all your income from operations on interest expense. You have no money left for expanding the company or paying employees or anything like that. So obviously you want this to be as high of a number as possible. Ideally, maybe 20 dollars of income from operations and only $1 of interest, right? So it's covered, the interest is covered many times over. Now let's look at measuring profitability. So some of the things we've done: gross profit margin percentage, the operating income profit margin percentage, our DuPont analysis that we'll review, the rate of return on sales, the asset turnover, the rate of return on total assets, the leverage ratio, the rate of return on common stockholders' equity, And finally, we'll look at the earnings per share of common stock. So gross profit, remember, is your gross margin. So gross margin percentage is just your gross margin dollar amount divided by your net sales dollar amount. So if I have revenue, or also known as net sales, of 100, and I have cost of goods sold of 20, my gross profit is 80. My gross profit percentage is just 80 over 100, or 80%. The operating income or profit percentage, same thing. To get the percentage, I'm just going to take the operating income divided by net sales. So then, as a reminder, we have this thing called DuPont analysis. So DuPont analysis essentially takes our return on equity. And our return on equity, you could just calculate by itself. You just take net income and divide it by, and there's a star because you're going to subtract preferred dividends. We'll see that here in the next slides. But we're going to take net income and divide it by average common stockholders' equity. So that's how you calculate return on equity. But DuPont analysis lets us break this out into individual components. And why would we want to do that? Well, because if our return on equity is really good or really bad, we can actually go in and figure out, why is it really good or really bad? What is the driving force? Is it part of our return on assets? And remember, our return on assets is just our net profit margin ratio, net income divided by net sales, times our asset turnover ratio, net sales divided by average total assets. So how efficiently do we use our assets, and how much of each dollar of sales do we bring to the bottom line, right? So we can see, do we have a really good net profit margin ratio? Do we use our assets very efficiently and we have a really good asset turnover ratio? Or remember, return on equity is our return on assets times the leverage ratio. So, or is it that we're just using a lot of leverage, right? So this is average total assets divided by average common stockholders' equity. So which is it? Which component here is it that is driving our return on equity? So that is what DuPont analysis is able to do for us. So here, you remember in this previous, you saw these asterisks. What it meant is really you take net income and subtract any preferred dividends. Very often you won't have any of these, so that's why earlier they didn't show that. But just know that you're going to subtract preferred dividends if you have them. So your rate of return on sales, also known as your net profit margin ratio, is your net income, subtract any preferred dividends, divided by total sales. So the higher the percentage, the more profit you generate by each dollar of sales. Your asset turnover really is measuring how efficiently the management is operating the company. It's comparing your net sales to your average total assets, right? So that's your average, or your asset turnover ratio. The rate of return on total assets is simply your rate of return on sales, right? Your net profit margin times your asset turnover ratio. That gives you your return on assets. And then we have the leverage ratio, where we take our average total assets divided by average common stockholders' equity. So this is really showing the proportion of each dollar of assets that we financed with stockholders' equity versus liabilities, right? And again, our rate of return on common stockholders' equity, or return on equity, we can calculate by just taking net income, subtracting preferred dividends, dividing by average common stockholders' equity. Just a reminder, beginning plus ending divided by 2. So we can use DuPont analysis, or we can just directly go and calculate it here. And earnings per share, this is by far the most common measure of how cheap or expensive a stock could be, by comparing the price that we're paying in the market to earnings per share, which gives us the PE ratio, and we'll take a look at that. To get that, we need this earnings per share calculation. The way we calculate it is we take our net income, subtract any preferred dividends, and then divide that by the average number of shares of common stock outstanding. That gives us our earnings per share. And so just like I said, when we have the earnings per share, we can plug that in to get the price per earnings ratio. And finally, to analyze stock investments, we can also use the dividend yield. So the price to earnings ratio just takes that earnings per share that we calculated, puts it in the denominator, and in the numerator, it takes the market price per share of common stock. So you go to Yahoo Finance, you look up what the current price per share is in the markets, divide that by earnings per share, and that gives you your PE ratio or your price to earnings ratio. It compares the price to the earnings, the price per share to the earnings per share. The dividend yield takes a look at the stock's market value and compares it to the dividends that you'll receive. So this turns into a percentage. So if I have dividend per share of common stock, let's say of $2, and each share costs me $100 in the marketplace, that means I'm getting a 2% yield on one share of common stock of this company. So wrapping up this chapter, what are some things that could go wrong when you do ratio analysis, right? Or what are the limitations of doing this sort of analysis? Well, it can show us that something's wrong, but it does not necessarily tell you what the problem is, right? So you have to do some digging around to figure out what exactly the issue might be. Also, things like legislation, international affairs, scandals, other factors can quickly turn profits into losses. So just because you do some amazing ratio analysis and you really think a company is going to do well, there's some of these external factors like scandals and legislation that really the ratios will not predict for you, right? It's important to analyze ratio over periods of years so that you can consider all the relevant factors. For example, a store like Best Buy, when do you think they have most of their sales? When do they sell the most? When is their revenue the highest? Around Christmas season, right? So you need to compare stores like Best Buy over years so that you don't only look at periods that are really good or really bad. And there's always going to be uncertainty that's involved here. So there is no kind of sure thing when you do ratio analysis and make decisions based on it. So let's evaluate the quality of earnings. So what is earnings quality? It's really assessing whether a company is showing its earnings in a conservative way, right? Or are they using a bunch of accounting manipulations to make their earnings look much better than they really are? So what are some components that we would look for? Well, are they using conservative revenue and expense recognition, right? Are they being thoughtful about when they recognize revenue, and are they showing expenses, as quickly and as possible, right? Or are they trying to be cute with accounting tricks? So things we can look for, like a high and persistently improving gross profit percentage, that would be pretty good, right? Stable operating expenses or even declining operating expenses when you compare them to sales, that's also a great sign, right? Sales are going up and operating expenses are staying the same or maybe dropping. That's fantastic. More money to the bottom line and into the pockets of the owners of the firm. And also separating any ongoing earnings from any discontinued operations, right? If your company has stopped or discontinued some operations, make sure that we take that out of the operating section of the financial statements so we don't make it all muddy and unclear. So outsiders will audit the financial statements. So for those of you who know some of the accounting firms, PricewaterhouseCoopers or PwC, Ernst & Young or EY, KPMG, Deloitte & Touche, all of these are major accounting firms that really operate in the entire world. And what they do is they have a systematic process where they gather evidence that verifies what the company's management puts in the financial statements, right? Once they've done that, they issue an opinion on how fair the presentation of the financial statements is. So these audited financial statements give you as an investor or a creditor some assurance that they are prepared with integrity and reliability, right? So that's when I look at a 10K, I have a fair amount of confidence that those numbers are accurate and correct. What are some red flags to look out for? Any earnings problems that you may come across, if you see that cash flow is decreasing, if the company has too much debt, right? So it might be under stress now or in the short in the near future. If you see that they have an inability to collect receivables, maybe they started selling to much less credit-worthy parties. If inventories start to build up, right? What's going on? Why are they not able to move their inventory? And any trends that you'll see in sales, inventory, or receivables, analyze them. Are they positive? Are they negative trends? And one of the things that is in investments that you'll learn, this is kind of an introduction to investments, but one of the theories that's come across from the University of Chicago originally and really taken hold over the last 50 years or so is this concept of efficient markets. What it tells us is that the market prices of companies fully reflect all the information that's available to the public, right? So the managers, there should be an A there, the managers can't fool the market simply with accounting gimmicks, right? The market as a whole sets fair prices for the stock because you get all the information of thousands of participants, tens of thousands, millions of participants at any given moment is reflected in the prices. So your appropriate strategy is managing risks, diversifying investments, and minimizing transaction costs. So if you want to have a positive investment experience, those are the key factors to consider. So these last few slides simply take a lot of the ratios we've talked about, gives you the name of the ratio here, gives you what the mathematical computation is, and explains what some of the information provided by this ratio is. So you can see there's this slide, and this slide that discusses all the various ratios and just condenses it into a couple different slides. So that is it. Again, this chapter should be hopefully pretty straightforward. It is an entire semester class, financial statement analysis. And if you want to be in business, I highly suggest that you do take financial statement analysis at some point in your education. But that is it. So this covers the class. Any questions that may pop up, please feel free to ping me.